makes an effective internal control system. So, like we said, the internal controls are the processes, the policies, and the procedures in place to enhance the activities of the organization and help in culminating in good bottom line of financial reporting, enhancing enhancing efficiency, reliability, prevent and detect fraud or errors, protect assets and resources, support sound decision making with accurate financial reporting. Okay, so what makes an effective system of internal control? Now, the International Standards on Auditing 315 identify 5 components, which is also the COSO framework. The COSO framework. The COSO framework is the Committee on Sponsoring Organizations that came up with that framework and it makes up the internal control system, talking about the control environment, talking about the entity's risk assessment process, the information system, and control activities around internal controls, and the review and monitoring of those controls. We'll be talking about these 5 components subsequently. For internal controls to be effective, they must ensure that, number 1, the culminating reliability of financial reporting, because transactions are accurately recorded. Internal controls, for them to be reliable, ensure that transactions are classified and summarized, and financial statements reflect a true and fair view. Secondly, internal controls, for them to be effective, must safeguard assets. Company assets include non-current assets, current assets, protection against theft, misuse, and loss generally. And regular checks, reconciliations, physical verifications, and custody procedures are in place to ensure safeguarding of assets. Number 3, operational efficiency is what internal controls are all about. Processes can run smoothly and efficiently, avoiding wastage and duplication of efforts. And also, importantly, if somebody is not around, the system should run. It's a good way of operating efficiently. If somebody is not around and systems are halted, then there's a problem with that internal control. There should be clear policies and segregation of duties to prevent errors and bottlenecks. These are good systems. And finally, or fourthly, compliance with laws and regulations are good products of good controls. Controls ensure the company meets legal, regulatory, which are external obligations generally, while good controls also enhance controls meet internal meeting implementation of policies, procedures, and ensuring they work, not just are designed. Compliance with laws and regulations reduce exposure to penalties, fines, and reputational damage. So the characteristics of an effective control system, a good control system, there are clear responsibilities, delineation, delegation, and division of labor. Everyone knows their role. There's also segregation of these. No single ones control all aspects of a transaction. Talking about the maker, the checker, and the approver are 3 different distinct people for you to have good, effective control. Most of the fraud cases we've seen that culminated or crystallized in the global space as a result of these issues that were not properly checked and cleared. Segregation of duties, you see where somebody can make and check and approve at the same time. Those were issues that culminated in long-term issues with an organization, and it crystallized into fraud. Areas of authorization and approval, major actions, the characteristic of an effective control system. And I was talking about their responsibilities, and I said the first one is everyone knows their role. Then segregation of duties, where no person controls all aspects of a transaction, is shared among different individuals. We also have the authorization and approvals that ensures major actions need proper approvals from particular persons. And also, it said proper documentation should be in place where records provide evidence of compliance to SOPs or policies. And there should be monitoring and review regularly by internal audits, internal controls, risk, compliance. I was talking about an effective control system. And I said that number one, clear responsibilities. Everyone knows his role. Another one is segregation of duties. No single person controls all aspects of a transaction. And thirdly, authorization and approvals. Major actions need proper approvals for them to fly. And proper documentations, speaking to records providing evidence of compliance to SOPs and policies. And we have monitoring and review, talking about regular internal checks by internal controls, risk management, compliance, and internal audits, and also external audits. And also talking about adaptability is an effective, is also a feature of an effective control system where system evolves and we have new and emerging risks, technologies, and environmental change. A good, effective internal control system should be able to adapt quickly. Change management should take place and enhance such controls. So a quick scenario, an example, talking about a retail business that deals in cash. Most retail businesses deal in cash. So cash controls around the retail business includes a staff collects cash and another records it. That's a good control. And another supervisor reconciles it with sales to ensure that the proceeds or revenue collected is what is actually recorded. You see, this segregation of duties helps prevent theft or errors. So a key takeaway is that an effective system of internal control is preventive, is also detective, and is also corrective. So preventive in the sense that it's proactive. Before a risk crystallizes, it tries to install proper mitigants in place before a risk crystallizes. And it's also detective, that during activities, it could detect issues and correct. So it will be corrective where issues have happened, and from those events, you learn lesson and correct to forestall further occurrence of such incidents. So those are the proper components of a good, effective control system. It not only stops errors and fraud, but also explains smooth, compliant, and efficient operations. So that's what makes an effective system of internal control, actually. All right, so any question on that contribution, observation on internal control? Okay, let's run. I'm hoping we could finish this this chapter this night so that in the next class we'll be able to attend to past questions. All right, let's look at the first component, the control environment. The first component of internal controls is the control environment. What does this entail? The control environment, by definition, is the overall attitude, awareness, and actions of the board of directors and management regarding the importance of internal controls. So he starts with attitude. Some call it the tone at the top. The tone at the top. Attitude, awareness. It cascades down from top to bottom. That's what the control environment talks about. So if management shows a positive attitude, then staff and junior managers, middle managers will do the same. Invariably. That's what it means. Okay, so the statement is here. Setting the tone at the top is what management does, and the control environment, it provides the discipline and structure for effective internal controls. Some part of Africa lack the good control environment. The top are corrupted. So it cascades down to the citizens. Some very horrible countries in Africa, and that has bedeviled a lot of issues. You see, from the top, if corruption and negativity is at the top, not just for organizations, for countries also, it will culminate in negativity downwards. So the tone at the top is very important, not just for organizations, but for countries and for any system to thrive. Most countries in the West, in Asia, you see the tone at the top very strong. Once there's an allegation of corruption like this, in Asia, you see management team even going to commit suicide before investigations are carried out. That's to tell you how integrity are not played with. Once there's an allegation, I read of a story of an airline that crashed in Asia, one of the countries in Asia. And the health and safety team that supervised the airline or that aircraft before it took off resigned immediately after that crash. They resigned their appointment and submitted themselves to investigation. The tone at the top was clear. And after the investigation, it was found out that it was a software malfunction. So this tone at the top is very important for all organizations, for countries, for systems to thrive. Once it's clear from the top, you see that it will almost be clear from the bottom. And that is why they said a fish starts getting rotten from the head and it affects the body. That's a saying in one of the African proverbs. So the tone at the top is very key, and it's very important for organizations to take note of it, because that's the first component of the COPSO framework. And you see that the key elements of the control environment, according to the Institute of Internal Auditors, which is IIA Global, the control environment includes integrity and ethical values, honesty and ethical behavior. It must be promoted. Very important. And where you have a philosophy or management or country philosophy is chop, I chop, then you see the tone at the top has rotted. That's a bad philosophy. And nations that subscribe to such philosophies hardly go far. Chop, I chop. So that philosophy, operating style, openness, speaking to risk appetite, and approach to control is very important. I'm bringing it down to our African normal problem so we can understand this subject very practically. And the organizational structure also is an aspect of the control environment, talking about hierarchy, top to bottom, reporting lines. The organogram of that organization speaks to the control environment. Then the assignment of authority and responsibility is called delegation of authority. Some organizations produce or develop that into a policy, delegation of authority matrix. Everyone knows their role and their accountability. Then human resources policies, practices on hiring, training, retraining competent staff are part of the control environment. Then also competence of personnel, staff must have the skills to carry out their duties effectively, are all elements of the control environment. And why it matters is because a strong environment or control environment signals management commitment to sound controls, because a weak control environment increases the likelihood of ineffective controls and culminates in fraud and errors, which is very important. So take note that a strong environment is not a guarantee for effective control alone, but it reduces the risk significantly. And the auditor's role based on ISA 315 is that auditors must evaluate the control environment as part of their risk assessments by considering the board and management's involvement in design and implementation of these controls, which is their primary responsibility. Then a commitment to the control culture, working it out, not just having designs in policies and the policies are not working. Everybody does what he likes, but there's a policy on doing the right thing, but nobody does the right thing. But the commitment to implementing these controls is the board's responsibility and management. Then the existence of a clear organizational structure, you know what to do. Every hierarchy, every department, every unit, every staff knows what to do. And the promotion of a culture of ethical behavior. The HR policies that emphasizes quality and competence is also working and functional. A quick example of a strong control environment talks about the bank, or a bank where the board actively reviews risk reports from the second line of defense, enforces a strict code of ethics, and invests in continuous staff training. It lowers audit risk, talking about the audit model, control risk, detention risk, and residual risk. It reduces it significantly. But a weak control environment, for example, a family business where the owner overrides everything, he makes, he checks, he approves, hires relatives without qualification, and tolerates all kinds of shortcut. The risks are high when you deal with this kind of entity or you want to audit. So a key takeaway on the control environment is that the foundation of internal controls, if it's weak, other controls will likely fail and you have to do more work on substantive testing. Auditors must be careful in assessing the approach to use for such weak control environment. All right, so that speaks to the first component of internal controls, which is the control environment. Any question on that? Any contribution, observation, comment? Okay, let's run. We'll move to the next one, speaking to the entity's risk assessment. This is the second component of the internal control framework, risk assessment. Risk assessment is a process by which management identifies, number one, evaluates, number two, and manages business risks. Very important. So take note. The first thing is identification, evaluation, and management of business risks. And these risks must be managed because it could prevent an organization from achieving its objective. So a strong internal control system requires continuous risk assessment. It's not one-off, it's ongoing. Internal audits do it. Risk management does it if they have a risk unit. Also, the external auditors do it. So the steps first is to identify risks, spot them. What are those potential risks? You are proactive. For example, risk of fraud risks, compliance risks, market downturn risks. These are examples of risks that could be assessed. Then you evaluate those risks by deciding if the risks are significant and ranking them high, medium, low by way of importance and criticality. Then you manage those risks by putting controls and mitigants in place, put policies in place, and other measures in place to deal with them. Yes, please. Somebody is trying to interject. Go ahead, please. Please feel free. I think, Mike, you're trying to say something. Your mic is unmuted.
No, sir. Continue, sir.
Oh, okay. Somebody interjected. All right. So I was saying that the identification of risk, spotting them, it's very important first, then assessing them, deciding if they are significant in order of criticality, then also managing them, putting controls, policies, and other measures in place to deal with them. So the rule of International Standards 315 requires auditors to gain an understanding of the client's risk assessment process, evaluate how this process affects financial statements or financial reporting, then adjust your audit plan accordingly. So the impact on audit risk is that a strong risk assessment, the auditor may place more reliance on management's control. And the audit risk, talking about detection, control, and inherent, are low because you can see that a strong risk assessment process is in place. So where there is weak or no risk assessment process, the auditor must perform more of audit substantive testing and also independent risk evaluation, because audit risk is higher because there are no controls, internal controls around risk assessment, and it's either non-existent or is weak. So the auditor has to do more job in that area. So for example, a good practice risk assessment process, a manufacturing company performs quarterly risk reviews, identifies risks like supply chain disruptions, inventory obsolescence, and designs control around this, like alternative supplier stock reviews. This good practice will reduce the auditor's substantive testing or analytical procedures. But a weak risk assessment process for maybe small businesses with no formal risk assessment process, auditors must independently assess risks such as fraud risk, cash misappropriation, and outdated or obsolete stock. So a key takeaway is that as an auditor, you are not only interested in whether management does risk assessments, but in how effective those processes are, since this directly affects audit planning and the level of assurance required from the financial statements you are providing your opinion on. So that's very important on the second component of the COSO framework of a good control, internal control system. Any questions on this second one? Any questions? Okay, so let's run. The third component is the information system. It's actually control activity, but then I think this study pack put it as the information system before control activities. Okay, so let's look at the information system. The international standards 315 require that the auditor must gain the understanding again of the client's information system, including the accounting system or the ERP or the package the company uses. Yes, please. Yes, please.
Which headline or subtitle we are picking? What is it under? We're picking evaluation of evaluating the control environment. We have the entity risk assessment process, then the information system. Now, all these subheading,
They are
what's it under?
components of internal control. COSO framework of internal controls. Yes, there are 5 of them.
Okay.
So we are looking at the third one. The third one is the information system.
Okay.
All right. Okay, so the auditor must gain an understanding of the client's business and its accounting system and how it affects financial reporting. Because it helps the auditor assess the risk of material misstatement and determine whether reliance can be placed on the information system or not. So key areas the auditor must understand is that the auditor should be able to identify and evaluate the principal business transactions, the material ones, the core transactions of the entity. So for example, revenue, sales, purchases, payroll, transaction capturing, how transactions and events are identified and recorded in that system. Very importantly, the auditor needs to identify these principal business transactions and also the processing models, whether processing is manual or electronic, and how accurate are both these systems are very important for the auditor to take note. Then for the accounting records, are there manual ledgers or electronic database or enterprise resource planning systems, which are ERPs. So for example, the Sage package, SAP, Oracle, QuickBooks, FreshBooks, all those packages are used to generate financial information are very important to assess. And also the preparation of financial statements, talking about the processes for adjustments, consolidation, reconciliation, and management review are key, very important. Also, IT and cybersecurity management, the auditor needs to look at this in how the entity manages risks such as antivirus, firewalls, system breakdown, hacking, data corruption, and cyber attacks. So the components of a good information system talks about the system generally consisting of infrastructure, physical hardware, servers, networks, and computers. Aside the hardwares, the software, talking about the ERP, the accounting software, either manual systems may be used literally or none, talking about a mix of using Excel or just the ERP only. Then also the people operating those systems, employee who operate and monitor and authorize this transaction. What's their quality? Are they well trained to do this, perform these activities? Then policies in place, procedures, manuals, documented SOPs for transaction processing and approvals, are they in place? And also data, talking about inputs, processing outputs, and storage of business and financial information against crashes or losses. Are these data protectors in place? So generally, frameworks that would enhance the IT or information systems of our organization are the control objectives for information and related technologies. We'll be seeing this elaborately, I think, when we come to chapter 16. So the use of these recognized frameworks in IT governance and system development provides extra assurance to auditors. If they see such packages and framework in place, they have this assurance that controls are working. So COBIT is a good control and is provided by ICAN, the same body that administers CISA, because they help evaluate business objectives and effective risk management are in place for reliability of information. So COBIT is a good framework that helps provide and protect information systems. So for example, a retail business that uses POS systems to capture sales automatically, like QuickBooks POS. There's QuickBooks, the package itself. Then you have QuickBooks POS for supermarkets and all that. So a retail business or a supermarket can capture sales automatically with QuickBooks POS and integrate it into that ERP. So transactions are processed electronically to reduce manual error, risk, and human effort. So risks around this could be system downtime, customers are waiting and the POS is down, they want to buy and go. So risk around that should be assessed. Cyber attacks, the auditor evaluates these IT controls. So for a small family business, manual cash book records, writing physically on hard cover booklet, hardcover book on purchases and sales are features of a small business record keeping. And it's a weak infrastructure. They may not have softwares. So the risk is generally around human error, misappropriation, incomplete records. The auditor has to increase substantive testing in such a situation. So a key takeaway for the information system component is that the quality of the client's information system determines how much the auditor can rely on controls, whether to increase his analytical procedures or extend his substantive testing. That's it about the information system component. Any question on this? Any question on the information system? So that we'll go to the fourth component. All right, so let's look at the control activity, which is the fourth one. Control activities are the policies, the procedures, and the practices, which is beyond the control environment because that speaks to the apex or the strategic direction provided by management. The activities are doing what is in the policy, implementation of policies, procedures, and practices. Is beyond control. It helps ensure business objectives are actually achieved by the doing. The control environment designs and provides a roadmap for what to do. Now, the control activities is in the actuality of doing. Errors are prevented when you do or perform the policies and procedures. Errors are prevented and detected and also corrected in the financial reporting process. And that's the essence of control activities. They are essentially the practical application of internal controls. The category of control activities includes authorization controls, ensuring transactions are approved at the right level of management. Top management, middle management, lower management. Approvals are actually working and authorized. So, for example, a manager signs off on credit sales above 5 million. So once credit sales is supposed to be, once credit sales are secured or provided to a client, the manager should sign. And physical controls over asset safeguards from unauthorized access or theft or damage should be in place. So these are examples of good authorization controls. An example also is the restricted access to inventory or strong room for cash. This is a good physical control. Safes and all those cash vaults are good controls for cash. Arithmetic numerical controls include verifying accuracy of processing and calculations, good controls. So an example is checking supplier invoices to confirm correct tax, VAT, discounts on those invoices. That's good arithmetic controls. Then we have accounting controls, which ensures accuracy and completeness of accounting records. So, for example, the control account reconciliations and receivables and payables reconciliations are good examples of accounting controls. And we have management controls, which is provided by the apex, and the oversight by management is over operations, tactical, and their performance, which includes supervising staff, review of performance reports, monthly or quarterly, use of budgets, variance analysis, key performance indicators, and performance monitoring. These are good examples of management controls. Segregation of duties, very important. Splitting tasks among individuals so one person does not have full control over a process is a good way of controlling and having good control activities, which reduces risk of fraud and undetected error. So for example, a person prepares a payment, another person authorizes it, another person records it. So maker, checker, approver, recorder, something like that is a good example. So the importance of segregation of duties is that it reduces, it detects errors. Different individuals can easily spot mistakes quickly. And it also helps the fraud prevention. Fraud becomes harder since collusion will be required. They have to agree and collide to perform the fraud. So an example is in payroll processing, HR maintains employee records, payroll staff calculates salaries, and finance authorizes payment. You can see proper segregation of duties in this example. So for practical audit angle, auditors should test whether these controls exist, either by physical verification or by testing of documentation. They should test whether these controls exist and operate effectively. So weakness in any of these control activities may increase control risk in the audit risk model, requiring more substantive testing. So key takeaway is that the control activities form the core defense of internal controls. If control activities are strong, auditors can place reliance on them and work to reduce the detailed substantive testing required. But if it's weak, then auditors must increase their substantive testing or analytical procedures and other questioning of the system. Very important. So that will be the end of the control activities before we move to the final one. Any question? Any questions? All right. We have the next one. I think we have 2 more minutes. So do we stop here, or can you give me 5 more minutes so that I can land? Let me conclude this last framework. Do we stop here, or we should go on? Sir. Okay. Are we aligning with his thought? Is it okay with us? At least let's have 1 or 2 others to concur. Okay. We have 1 or 2. All right. That's fine then. Let's conclude with the monitoring of controls. This aspect is important within an internal control system because management should review and monitor the operation of these controls we've talked about on a systematic basis to satisfy and have that comfort that the controls are adequate and are working and they are being applied properly. The same ISA 315 requires that the auditor should obtain an understanding of the monitoring process. So what is the definition, somebody may ask, of monitoring of controls? Is a process by which management reviews, evaluates, and ensures that internal controls, number 1, are still adequate for the risks faced by the business in the interim and are being applied properly and consistently. Very key. Monitoring of controls is the process by which management reviews, evaluates, and ensures that these internal controls are still adequate to address risks faced by the business and are being applied properly and consistently. So it's not enough to design controls. It must always be monitored to confirm it works and is effective. So why is monitoring important? Is because business conditions are dynamic and risks change over time. So for example, new technology is introduced, regulations and economic shifts will necessitate monitoring these controls to change with it. And controls that are effective last year may become obsolete controls this year or today. So monitoring ensures that weaknesses are identified early and corrected. Very, very important. So forms of controls include ongoing monitoring, regularly, day-to-day supervision, oversight by management, month-to-month checks, quarter-to-quarter checks, and all that. So for example, line managers review reconciliations and variance reports monthly is a good way of monitoring or ongoing monitoring. Separate evaluations, talking about periodic counts, stock counts, independent reviews and controls by internal audits and external audits. So for example, internal audits or internal auditors review payroll controls every quarter is a good control based on their audit plan. And the combination approach is that many organizations use both ongoing and periodic evaluations for stronger assurance monitoring. Very key. So examples of monitoring activities talks about the internal audit department, their reviews and their reports. The internal audit checks the first and the second lines of defense. And this supervision There are also supervisory review of performance indicators, reconciliations, and exception reports by management, top management, management committee, talking about the audit committee, finance committee. For larger companies that have all these committees, they meet to review and supervise KPIs, exception reports, other review activity reports, and all that. These are good monitoring of activities. The audit committee, like I said, there are companies where you have risk committee, audit committee, compliance committee, and all that. Provide oversight on risk management and finance reporting. You follow up on control deficiencies identified in prior audits. So the auditor's responsibility is that he must obtain the understanding of the client and how the client monitors the internal control systems, report control weaknesses, and implements corrective actions. So the monitoring is weak. We show that the auditor will need to increase substantive testing and reduce reliance on internal control. So a key takeaway is that monitoring acts as the control over the controls. Very key word. Take note of that. Monitoring acts as the control over the controls. Without effective monitoring, even well-designed controls can fail silently, which is true. Auditors must assess whether management actively monitors controls and responds effectively to its deficiencies. All right. So, ladies and gentlemen, thank you for your patience. We'll stop here today and we'll continue with the next session in our next class, hopefully in our next meeting. Do I have any questions?